August 31st, and we are getting close to 37,000 subscribers. If you like your daily financial news and you haven't yet to subscribe, do me a favor, subscribe today. Let's get over 37,000 on our way to 50,000, at which point we will throw a party. Thank you very much. Let your friends know, subscribe, interact, say hello, all of that good stuff. So lots and lots of stuff going on, lots of stuff we've talked about over the last 6 months or so starting to come out. These are things that we should watch for. First and foremost, let's start at the top. Snap. Snap has been in the news and on this channel several times. I think 6 months ago they were talked about because they missed earnings. Then they were on the channel 3 short weeks later when they had to cut expectations 21 days after they told us. Then they missed. Then they said, hey, we're not going to tell you about the future. Yesterday, and it was confirmed this morning, they are cutting 20% of their employees. Last employee count had them about 6,500. So we are looking at about 13,000 layoff notices. I do want to remind you something that I have pushed for, advised repeatedly. This is yet another reminder. Get close to revenue. Some of you are very, very excited to work on new toys, new tech, the next great thing. Executives in a down market, when they are going into cash preservation, don't care. I have been in those board meetings. I have cut a project that I had blood, sweat, and tears in because we didn't have the cash to get it to the finish line. Why do I talk about this with Snap? It's another example of get close to revenue. A lot of the cuts at Snap are coming from new products. Apparently, there was a product called Pixie. I know nothing about it except it wasn't producing revenue and it was consuming cash. So it's got to go. If you are in tech or applications or a business or whatever, and you are in this new product stream, it feels great. The money, people are throwing options and stock at you and go, you're our future. There are people sitting with a spreadsheet going, that project's burning $100 million in cash. It won't be cash neutral until 2026, best case. Out. Just like that. Just like that. So get close to revenue. Farm, don't hunt. If you're a salesperson, you know what that means. Next, ADP report. ADP report, I don't know if you know this, but they have not shared their monthly numbers for 2 months. They have gone back and revisited the model because it was so off from the Bureau of Labor Statistics, which will come out Friday. ADP report said we had job creation of 132,000. We're not talking about that. We are talking about wage spiral inflation. If you have been on my channel, perhaps the greatest disagreement other than housing prices is I believe we are about to see wage inflation for the next 3 to 5 years. In fact, last month was the first month of the entire year where we had real wage inflation. Now, we have had nominal wage inflation all year. We had real wage inflation last month. If you've been on the channel, you know what we mean by real and nominal. These are very important economic terms and sometimes confuse people. What do we have here? ADP report just said wage inflation up 7.6%. ADP report breaks it down by sections or areas of the economy. Did you know one section called hospitality and leisure? Wage inflation for the month was up 12.1%. Yes, folks, I do think, and again, a lot of the things that I talk about in the future are early. They're not on the mainstream media. They're certainly not what the other talking heads are talking about. But if you go back and watch the videos, we're pretty good on this channel and stuff comes in. So I think wage inflation is, I don't know, worse. I don't know. It's hard to say wage inflation is bad because wage inflation helps everybody's income. But realize wage inflation scares the Fed because as wages go up, companies can reduce margin for a little bit, but then will pass on cost. That is why the spiral is so scary to the Fed. And I think it's entrenched. Look at all the unions that are spinning up. I think Chipotle just did one. Amazon's done one. I think Apple stores have done one. Unions are stronger today than they have been in decades. And it will all lead to more and more wage inflation. In fact, wage inflation will be so sticky and around for so many years. I think it is the thing that fixes housing affordability years down the line. Next up, mortgage demand. Mortgage demand has gone down again. It's down 23% year on year, down 2% week on week. Not good. And folks, something you've heard me talk about the last couple of days, I do not see a better 2023. I think the housing market enters a depression next year. I think transactions for new homes, existing home sales, fall 50% peak to trough. I think rates are going to 7. We know what happens when rates go to 6. I think they're going to 7. We're more on that in a minute. Don't know if you saw this, but Lego. Yes, folks, if you've ever played with Legos as a kid, you ever bought Legos as a birthday or Christmas gift for niece, nephew, grandson, whatever, Lego is dropping $1 billion. That's with a B, folks. $1 billion building a brand new factory in Virginia to make Legos right here in the great United States. So shout out to the team at Lego for dropping $1 billion making Legos right here in the United States. Good for them. Lastly, we've had more and more talk from Fed presidents. We are going to get more and more to come. Fed President Mester, where is it? What is her first name? Loretta, I believe. Loretta, where is it? Oh, it must be on my third sheet. I actually had a third sheet today. Yes, I think it's Loretta. Loretta Mester. Oh, there it is. Loretta Mester sees Fed funds rate getting to 4% early next year and no cuts in 2023. If you've been watching my channel, that's exactly what I thought was coming. I think the Fed has to bang us with 75 on the 21st. Our third 75. It is coming. It'll take us to 3%. It is going to be bad. The cost of borrowing money is going up. The dollar is getting stronger. 2023 is going to be painful. The Fed told us it is going to be a depression in housing, a lot less transaction. 2024 will be better. Frankly, it will be hard to be worse. 2024 will be better. It's about surviving 2023 if you are in the business. I think companies like Snap that are not profitable will have a hard time raising money. We will see more layoffs. We are going to see the unemployment rate go up. Currently sits at 3.5. We will see where it's at on Friday. A couple of things about the Case-Shiller Index. Remember, the Case-Shiller Index fell a whopping 1.9%. We talked about that yesterday. Yes, folks, the Case-Shiller Index fell, crashed 1.9% in a month. It went from 19.9 to 18%. Goldman Sachs is talking about the Case-Shiller Index for December. They are making a prediction. And let's be clear, the Case-Shiller December numbers won't actually come out till February. I don't know why anybody looks at the Case-Shiller numbers. They're 2 months behind. They are what they are. But Goldman Sachs is saying at the end of December, the Case-Shiller Index will be cut in half, roughly. It will be 9.4%. So 2022, Goldman Sachs is saying home price appreciation will be up 9.4%. For the record, folks, that is a positive number. I believe it will be positive as well. I actually think it will be lower, though. I think in December, home price appreciation year on year will be more like 6%. But hey, we are where we are. More importantly, Goldman Sachs came in and said, hey, December of 2023, what will Case-Shiller be? I've never talked about December 2023. I wanted to see what Goldman Sachs said. Goldman Sachs said it will be up a whopping 1.8%. Couple of things. Remember our earlier discussion, real versus nominal. Goldman Sachs is saying Case-Shiller will be up 1.8% nominal home price appreciation. If between you and I, we could agree inflation is 4% next year, real home price appreciation would be negative 2.2%, right? You take 1.8, you minus 4, you get a negative number, in this case, negative 2.2. Again, folks, a lot of housing numbers are always reported in nominal terms. You and I next year will certainly talk about nominal and real. A nominal 1.8 in an inflation world of 4 is actually a real negative 2.2. Anything else I want to talk about today? I guess HP, Hewlett Packard, talked about not only consumers slowing down, which we heard from Best Buy. HP actually says that commercial companies are slowing down PC purchases. That is not good news. Next up, wealthy Americans. Wealthy Americans are not feeling better. If you look at the consumer sentiment survey from yesterday, it was better than expected. But what is really odd is if you look at the numbers, the middle class and below felt a lot better. Gas prices down 80 days in a row. Lower income, middle income felt noticeably better. The wealthy felt worse. Does that make sense? Absolutely. Fed President Jerome Powell basically said on Friday, hey, Mr. and Mrs. Wealthy, I'm coming for you. You have lived a good life the last 2 years. I am going to reduce the asset prices of your portfolio, of this, of that. We are going to help everybody else. So the 10% that own 90% of the stocks, you are going to get hurt. The rest of the 90% are going to feel better. That's exactly what Jerome Powell wants, and he is getting it. I thought it was really funny that consumer sentiment is already showing the wealthy retreating and everybody else feeling better. I think Jerome Powell loved that report yesterday. Next up, the JOLTS report. JOLTS stands for job openings, labor turnover. Think quit rate. JOLTS reported record job openings, far exceeded expectations. The job market is hot, hot, hot. We will get confirmation on Friday. And I think, again, Jerome Powell bangs us with 75 basis points on the 21st. Above expectations was 10.3, and it came in at 11.2. Job openings, job market is still strong. And wages are up. Wage inflation is up. Again, remember we talked about wage inflation in the ADP report. Everything is reporting the last 48 hours on jobs. Jobs are stronger, wages up. Jerome Powell is coming after two things: the wealthy and the job market. Jerome Powell wants the job market to weaken, unemployment to go up, and he wants the rich 10% to feel less wealthy. That is what Jerome Powell's mission is the next 6 to 9 months. All right, everybody, take care of yourself. It's the Daily Financial News. Like, subscribe, comment. Please help us get to 37,000 today. I would greatly appreciate it. Like, subscribe, share. We get to talk with Anna Kelly later, Matt the Mortgage Guy, and we have a surprise discussion at 9 o'clock. So Lots of great stuff. Take care. Bye bye.